Hey everyone, it's Vincent Andreacchi, VP of Business Development here at ISG Transportation. Welcome to our last monthly market update for 2025. We're wrapping up the year with a holiday peak that's hit harder than many expected, driven by late consumer surges, winter weather disruptions, and ongoing capacity exits. We're seeing pockets of capacity tightness, particularly across the US, while Canada remains more muted as trade uncertainty continues to weigh on the market. As always, I'm here to break it down so you can plan effectively for 2026. Let's dive in by region. December brought a quieter close to the year for Canadian domestic lanes, with volumes softening and holiday demand focused more on imports and e-commerce fulfillment in urban hubs. Full truckload rates declined about 1.5% from November, reflecting looser capacity in inter-provincial routes and lower diesel averages around 1.48 Canadian per liter. LTL held steadier, dipping only 0.6% month over month, supported by parcel-related activity in Ontario and BC. Though year-over-year rates are flat amid broader economic caution, expect rates to remain soft or dip another 1 to 3% as post-holiday inventory destocking kicks in and tariff-related trade slows down. Into January and Q1 2026, expect rates to remain soft or dip another 1 to 3% as post-holiday inventory destocking kicks in and tariff-related trade slowdowns weigh on manufacturing flows. However, if the energy sector activity rebounds in the West, we could see selective firming in flatbed by 2 to 4%. Monitor fuel trends closely for surcharge opportunities. Cross-border has been a tale of two directions, as usual, for the past few months. Northbound into Canada saw volumes hold firm, with holiday imports pushing rates up a modest 0.9% from November, despite lingering tariff concerns on select goods like steel and autos. Southbound to the US moderated further, with volumes down 2.1% as exporters paused amid trade policy uncertainty, resulting in a 1.2% rate decline. Overall, there were some border delays from weather-added friction, but capacity was balanced outside of peak retail lanes. Heading into 2026, northbound could tighten with potential restocking, lifting rates 2 to 4% if US demand stabilizes. Watch for USMCA review developments that may add volatility. Southbound continues to face pressure, and heading into early 2026, we're expecting mostly flat pricing or a slight 1 to 3% pullback unless tariff relief broadens. My recommendation: build in buffer time for customs and consider diversified routing to mitigate risks. December finished with US domestic capacity tighter than expected. Load-to-truck ratios spiked to highs not seen in the down cycle, with dry van spot activity surging amid winter storms and late holiday pushes. Full truckload rates climbed 3.2% month over month, particularly in reefer and van out of the Midwest and Southeast, while LTL pushed through increases of 2.8% as carriers capitalized on capacity constraints. Year over year, we're finally seeing some positive momentum, with volumes muted but rates firming on exiting carriers. This momentum should carry early into 2026, with truckload rates potentially rising 4 to 6% in Q1 as capacity continues to contract and the economy starts to surge. However, holiday extensions and weather could add some upside volatility, so secure capacity now for January bids to avoid any spot market spikes.